You see my slide?
Yes, I see it.
All right. So systematic risk, risks in the system, the tendency of securities prices to move together. So very testable. You know, you have to be able to contrast systematic risk with unsystematic risk or selection risk, right?
Hmm.
Selection risk was there were 10 equally suitable ideas, Houston. We picked one of the 10. The other 9 did fine. The one we picked went bankrupt. That's called selection risk, unsystematic risk, and very testable. The easiest way to avoid that is diversification. And then the test question is to recognize when we're discussing diversification as it relates to systematic risk that it does not eliminate. In other words, risk, the way they say this on the test is that risk prevails despite diversification. So they'd say, what type of risk prevails despite diversification? In other words, diversification will not take care of this risk. And you would say systematic risk,
Okay.
right? And the easiest way to avoid selection risk is in a mutual fund, and that's testable. And then they typically say, well, what is a risk that you would still have in a mutual fund? And then you would say, well, the risk that still prevails is systematic risk in that mutual fund. So market risk is a type of systematic risk. Inflation is a type of systematic risk. Now, they also ask on the test about 2 things that can be used to mitigate inflation risk. Inflation goes up. That's pretty bad for fixed income investment vehicles, but we have 2 things we might want to recommend to somebody who's worried about inflationary risk that in the future, their money won't buy as much as it does today. Sometimes we refer to that as purchasing power risk.
Mhm.
And you remember too, it's the same as that was on your 7. What might we recommend to somebody who's worried about inflationary risk?
Um, Tips, and then I remember equities.
Yeah, right on. Good job.
Okay.
Treasury inflation protected securities. And indeed, you got it right. Common stock would be what we would recommend to somebody who's worried about inflation. Interest rate risk. Again, it doesn't matter what bond you own. If you own a bond or a bond fund, if you own a bond or a bond fund, it doesn't matter. If interest rates go up, bonds are going down. And remember, preferred stock is also a fixed income investment vehicle. And again, here you could avoid, there's 2 risks when buying bonds. One, as we just said, is interest rate risk. And the other is credit risk. And credit risk, you can diversify, right? You can make sure you don't have all your eggs in one basket that defaults,
Mhm.
right? But not interest rate risk. Interest rates prevails again, despite diversification. So that's kind of the thing that we're using to answer these kind of questions.
Okay.
Currency risk. Now, I'm not being facetious. The US dollar is not a foreign currency. So, when we're talking about currency risk, we're talking about the euro or the peso or the yen or the yuan. And there is an investment vehicle that has currency risk. It's very testable. It's the same one as on your 7. What investment vehicle do we have that has currency risk?
80. Oh, ADRs.
Right? Yeah, the ADRs. Remember the ADRs? If that foreign business is conducting itself in that foreign currency, we have that foreign currency risk.
Hmm.
I usually use Telephones to Mexico Fund Company, or if it's Heineken, that's a Dutch company, or Nestle, that's a Swiss company. Now that doesn't mean we're still not going to have expose ourselves to that risk.
Hmm.
And the reason we might choose to still expose ourselves to currency risk is because we're looking for very testable negative correlation. We're looking for assets that perform different than the U.S. market. And you say, well, Dean, why are we, making international investments? I don't understand why we're making this asset allocation to international investments. And I said, well, Houston, under modern portfolio theory, modern portfolio theory, theory isn't truth. It's just a way of explaining things. And the more a theory can explain, the better that theory is. And a huge tenet of modern portfolio theory, very testable, is this idea of negative correlation. That you want to have a portfolio that if one thing's going up, the other thing's going down. If that thing's going down, the other thing is going up. So I can hopefully have a conversation with you saying, well, yeah, Houston, that particular part of our portfolio is not doing well. But we have an asset allocation over here that is, negative to that, negative correlation is going the other way. So we don't want to, under modern portfolio theory, add additional investments into a portfolio that have positive correlation, meaning they go the same way. So the reason to be adding foreign securities to a portfolio is to get negative correlation, because that would reduce the volatility of the portfolio.
Okay.
There's some more work to be done on that, but this is the risk, the entire market's volatility, very testable. We measure volatility by beta. And so under modern portfolio theory, you should be compensated for taking risk. And so if I tell you that the beta is 1.5, by the way, on the test, whenever we talk about the market, we're talking about the S&P 500. So that's testable as well, as to know that any discussion where it's about beta or the VIX or anything, when they say market, you should think S&P 500. And so, sometimes they have a question like, they might not just give it away to you and just tell you the S&P 500 went up, whatever. They might say an S&P 500 index fund. Oh, aren't they clever? And they tell you that went up 10%. Or they might say on the test, the market return was 10%. I'll just call it market return. And let's say the market return was 10%. And so I call you up and I say, hey, market went up 10%, Houston. And, we have a security that went up 13%. And you say, well, Dean, I can't believe you're chatting up 13. I said, well, gee, you're no fun, Houston. I mean, why are you raining on my parade? You say, Dean, my expectation, test question, my expected return on a stock with a beta of 1.5 is 15%. So you actually underperformed. And that's why I'm giving you a hard time. You shouldn't be chatting up 13%, because with a beta of 1.5, my expected return, that's a test question. There's a little more of this kind of modern portfolio stuff on 66.
Yeah.
Than there is a 7. I mean, same thing with the balance sheet. There's a little more, minutia on this stuff, is expected return. Now, I'm oversimplifying, which is always my job. But now if I called you, I could chat up 18%. I'd say, well, our expected return was 15 and I got us 18. And test question, what do we call the excess return over beta? We call that alpha. Seeking alpha. So we got 3% alpha. Now remember that alpha could be negative on the test, right? I could have got 13%. That's negative alpha. That's not good. If I really thought I was a, hot shot person, I'd say, oh, Houston, you don't pay me on the beta. You just pay me on the alpha. Because that's what I bring to the test. Now, there are people, again, this is called quantitative analysis.
Mm-hmm.
These are serious math geeks. Anyways, there are some serious math geeks who think that seeking alpha is a waste of time and resources because, it doesn't exist. And that's called test question, the efficient market hypothesis. Mm-hmm. That, everything that is to be known can be known. And again, same thing again, it's not truth. I get on my brother all the time. I go, Chris, you have a hypothesis. I have a hypothesis. For all we know, we both could be wrong. It's not truth. It's just a way of explaining things. I think my hypothesis is better than yours because it explains more, but who knows? Someday we might find out we're both wrong, right? To be determined. But the efficient market hypothesis states that all the information that is to be known is known and reflected in the price. Now, if you believe in that, then the recommendation would be to skip this whole thing about, beta and alpha and just buy the S&P 500 fund. You say, Dean, I'm willing to be accepting market-based return and have a low-cost structure and be tax efficient and control the things I can control. I said, okay, well, I'm going to put you in an S&P 500 track fund. It's kind of embarrassing to active management, but Vanguard on their S&P 500 says this fund is in the top 10% of all funds because it never underperforms the market. Mm-hmm. The reason it never underperforms the market, because it is the market, right? When the market does, that's what we're going to expect to do. Interest rate risk, this is again testable. And the way to get this is long and low. Long and low. So if I ask you what bond is the most volatile, we're going to go long and low. Now, when I teach Series 7, and you've probably seen this before elsewhere, a very popular thing to use is what's called the teeter-totter or seesaw. And the teeter-totter seesaw is where I say, okay, if interest rates go up, the bond's going down. Interest rates go down, the bond's going up. And here's what this relationship looks like. And every once in a while, I have a math bond geek, and we'll take exception to the teeter-totter. I said, well, why are you taking exception to the teeter-totter? I mean, it turns judgment questions into aim and shoot, point and click questions. And, I'm all about that. He said, well, the reason Dean and I take exception with that is because that relationship is not linear. It has more convexity. Who cares? It's just a fancy word for nonlinear. And so the fancy word we're going to use instead of, you don't answer any questions different, about volatility is called duration. You wouldn't answer the question any differently than you did on your Series 7. You would go with the longest term bond. The way we do it is long and low. So if I ask you which bond has the most volatility or has the highest duration, that's the fancy word for it, you're going to pick the bond that has the longest maturity and the lowest coupon. And that would be the bond that has the most volatility. Silicon Valley Bank is no longer with us. One of the reasons is all they had in their portfolio was long-term bonds. Once the Fed started raising interest rates, the bonds in their portfolio started dropping. Now, that wouldn't be a problem if they could hold it to maturity, but then, it became public how much money they were losing on their bond portfolio. Then all their customers started lining up saying, hey, we want our money. Now we end up having to sell the bonds, and that, that's a problem, right? So you would think that, bankers would have understood that risk. Inflation risk, we talked about that. Tips and common stocks, you nailed it. Currency risk, we talked about currency risk, and we talked about ADRs. And we said we're still going to do that just because we want to get something that negative correlation. Unsystematic risk is also known as selection risk. And if that means, again, the test question is diversification can mitigate that risk. Bernard Baruch's money is like an investment, or your money is like manure, and you got to spread it around, right? Mm-hmm. So the easiest way to do this is to diversify. And test question, the easy way for most people to diversify is in the context of a mutual fund. So business risk can be diversified away. Yeah, I feel really bad. I mean, GE was a blue chip until it wasn't. And I can't tell you how many families for generations have relied on General Electric as both an employer as well as an investment that paid them dividends. Mm-hmm. Until one day it didn't. And I had some of those as customers. I kept trying to tell them they should diversify. But, if you got all your eggs in one basket, it's been working for you. It's kind of hard to get people to, do something different. Right. Credit risk, we said we can diversify. We can buy more than one bond. Regulatory risk. Now, be careful on the test. A lot of people miss questions because they miss regulatory risk versus legislative risk. Right? Legislative risk is Congress. This isn't Congress we're talking about. This is the EPA or FDA or the Equal Employment Opportunity Commission changing the rules. And they change the rules, that could be a problem for us. And then I said legislative risk. I think a real good one is what happened to Berkshire Hathaway. Berkshire Hathaway owns 1 billion shares of Bank of America, and Bank of America pays an 84-cent dividend. So yeah, everybody who owns Bank of America gets the 84 cents, but it's a little more interesting if you have 1 billion shares because that's $840 million.
Right.
And it used to be that a dividend of one corporation paid to another corporation was 70% tax excludable. And then Congress changed it to test question 50% tax excludable. Right? A dividend of one corporation paid to another corporation is 50% tax excludable, meaning Berkshire Hathaway only owes taxes on $420 million, not $840 million. Now, test question, what's that called? That was called legislative risk. Whenever, I think what Congress giveth, Congress can taketh away, right? Senator Roth is no longer with us to protect his Roth IRA. I think that thing is so sweet that someday my progressive friends might take over Congress and get rid of that, right? So changes in the tax laws. So any investment, very testable, any investment that has any tax advantages, muni bonds, the dividend thing, life insurance, a Roth IRA. I say, Houston, that's how things stand today. But, Congress can change its minds. I just want to know you have legislative risk. Sovereign risk. I kind of joke in the old days, in the 19th century, if a country defaulted, they'd send in the Marine Corps and we'd take over the port and we would collect the money until you paid the interest and the principal. In today's society, we can't send in the Marine Corps to take over countries that are in default. What are you going to do? I mean, you're not going to send in, military forces. So you have the risk here. Two countries right now that are close to defaulting are Turkey and Argentina. And you don't really have much recourse, right? I mean, you're going to take Turkey to court and Turkey to make them pay. It's, that just ain't going to work, right? Or Argentina. So you have more risk that the government could default on its debt, and you have less, what we call, you're taking a legal test, by the way. So you want to try and get comfortable with more legalese, right? Sometimes they have attorneys taking this, they go, man, if I fail, it's going to be embarrassing. They go, absolutely, it'll be embarrassing, because if everybody should understand the legalese, it's you, but the legal term for what we can do is called a remedy. If I ask my attorney, what is a legal remedy for me? I'm asking, what can we do now that they've defaulted? And what I'm saying is this has more risk, because when a government defaults, there are less legal remedies available to you, right? You're going to say, oh, I'm going to sue that country. I go, well, good luck on that. I mean, that doesn't work so well. All right, so very testable. It's the same test question as your Series 7. What do we not recommend, right? So as an investment advisor representative, you are a fiduciary. And that's a much higher standard than being an agent of a broker dealer. You're supposed to make clients that are in your client's best interest. Now, we have 10 people in the room. We could all come up with 10 equally suitable different ideas. We would have a lot more consensus on what would clearly be unsuitable. So what I'm telling you is the test is very negative. Sometimes they don't ask you to come up with the right answer, but rather what would be clearly unsuitable given somebody's investment objectives. Do you recall from your Series 7, a thing we don't recommend to somebody who needs their investments to be liquid?
Who needs their investments to be liquid?
Yeah, what do we not recommend?
Bonds.
A partnership.
Oh, partnership.
Right, because in a partnership, a direct participation program, a partnership, you can't get in or out without the general partner's permission. Right, now, another question they give you. They have a question where your customer has sold his house in California. And the reason he sold his house is because he's being relocated by his company to Texas. And your customer says, hey, Houston, I think what I'm going to do when I get to Austin is I'm going to rent for a while just to get comfortable with neighborhoods and find my local favorite bars and that kind of stuff. And then I'm going to buy a house. And the question is, what would you recommend from the proceeds of the house for somebody who has a time horizon of 6 months? And you would say a money market fund, right? So liquidity tied with time horizon. So sometimes it will tie the liquidity to a time horizon. The time horizon for investment is, really important. I say, what is the time frame for this money? You say, Dean, I need to redeploy this in, 6 months. I go, geez, probably shouldn't be buying you a, growth stock or something. Okay, so opportunity costs. Opportunity costs involves both systematic risk and unsystematic risk. It's the rate given up on one investment to invest in another. In Houston, I have a lot of opportunity costs in my life as an older guy now. I like to sit on a lot of cash, and that cash could be deployed doing other things for me. My bank loves me that I'm just sitting on a bunch of cash, but it's not very smart. So, I'm giving up the opportunity to, invest it more aggressively and get a return. So here we have a bank CD paying 2. By the way, you can't make unfair comparisons either. You got to be real careful when doing this. I'm not supposed to make it sound like a common stock is better than a bank CD because they're different. They're entirely different investments. What I can say is that if we could get 8 and we get 2, the opportunity cost for doing that is 6. Now, there is a huge difference between those two, though. That bank at the CD is FDIC insured, and the dividend on a common stock most certainly is not. So there's no free lunch is the point. I mean, you're gonna, get a higher return. You got to take higher
risk.
Yeah, and you might say, well, Dean, I understand that's the opportunity cost, but I'm not comfortable with it. I mean, I had a person I was thinking about managing money for, and I was going to make an exception for my minimum investment. And I said, how are you going to feel if you lose your money? He said, I kill myself. I said, well, then you don't belong on the securities markets. You need to talk to your banker about a banking product or your insurance agent about an insurance product, because if you buy a securities product, you're going to have risk. This is the same exact question as on your Series 7. You have to rank securities from senior to junior or junior to senior in liquidation. As I say, capitalism without failure is kind of like religion without hell. And so if we liquidate a corporation, who gets paid? They're secured bondholders. Then who gets paid? The unsecured bondholders. Then who gets paid? The preferred and the common. You got to know that in sequential order, senior to junior or junior to senior. In other words, if there's nothing left, the common stockholders get nothing. Now, they also ask you to recognize what is the theoretical liquidation value of the business. And you should be able to tell me that that's book value. The answer sets are pretty important. The other choices I would have given to you is market value and par value, and those could have been the right answers to different questions.
Right.
If I said, what is a relationship in the secondary market? You would say market value. That's simply like Apple today is 171, $171 a share times the number of shares outstanding. And that would be the market capitalization of Apple. And that goes up and down every day, right? You should know the par value is an arbitrary number used to set up the books of the corporation. For bonds, very testable, 1,000. For preferred stocks, 100. That's very testable. Know that, because if you don't know that, then you can't answer questions about it's a 5% preferred or it's an 8% bond. So you got to know that's based on par.
Right.
Now, you don't have to deal with par values that relates to common stock, but par value for common stock is $1. Right? So those are all our values that we get tested on. Analytical methods. Now, this is an area where some people kind of struggle a little bit. Right. And so, the math is a little bit different here. And, I had a guy who was doing a 66 and he hired me for tutoring. He said, Dean, I'm not paying you $225 an hour to teach me how to do math. I'm a serious math geek. You give me any two numbers, I can tell you the third. I go, wow, that's certainly not me. I'm math challenged. Anybody offers me a calculator, I say, thank you very much. Good news, he passed, but he called me. He said, Dean, I did myself a disservice. He said, the reason I did myself a disservice is I didn't really have to do the math. They asked me to recognize the formulas. And, I could do it because I had to reverse engineer it. But mainly this category of the test, it's mainly about input and output. Do you recognize the math that goes in, the numbers, and what comes out? Not can you actually do the math? Now, a neat trick is called the rule of 72. 72 tells us either how many years we need to double money or what return we need to double money. And remember, we said time horizon is pretty important. Now, sometimes I get somebody who's kind of aggressive with me, and they'll say, well, Dean, you told me I was going to have to do any of this, discounted cash flow or present value, future value. I said, well, now wait a minute, take a strategic pause. And is that really what you were being asked to do? Because a lot of times it's not. A lot of times what it really is a hack to us is available by using the rule of 72, right? That I can ask you to do because, you have a simple function calculator on the test, right? So here, this is the formula for future value. Future value determines what an investment made today will be worth at some future date, given an assumed interest rate return and based on a number of compounding periods. So maybe my client says, let me give you an example of this. My client says, Dean, I have $100,000 today. I would like to retire. I'm 50 years old. I want to retire in 20 years. And I want to have $400,000. So then I apply this and say, okay, well, we're assuming the future value. We're trying to determine that. You're telling me it's 400,000, but let's see if that's what the number comes out if I do the math. So right now we have 100. What is our assumed rate of return? I mean, in other words, if we assume a higher rate of return, we're going to get there quicker. And if we assume a lower rate of return, we're going to get there. It's going to take us longer to get to this financial destination. How many compounding periods are there? How many years is this? Does this investment we're making pay us semi-annually? Does it pay us quarterly? What might be the case be? Now, as I said, for test purposes, it's not so much can you do this math. It's do you recognize what is necessary to do the math, right? So we need to know the present value today, 10,000. We need to know the rate of return, whatever we're assuming. That number could be whatever we assume it to be. Again, if we're conservative, we'll pick a lower number. And if we're aggressive, we'll pick a higher number. And then what we're solving for is what will that be worth the next number of years? And by the way, the term itself kind of gives it away. Future value, right? So we're going from the present value to the future value. So here is an example of that question. Now, you're not going to have to do the math. What is testable is kind of recognize, well, gee, this would be kind of a nice thing to be able to figure out. So there's our present value. We're assuming an interest rate of 8%. And this is a 10-year, or how many years was it? It's 9 years. That's our compounding periods. So the main thing on the test is, do you know the inputs? Boom. Now, when we crunch that, when we put that into our calculator, one of the reasons you can't do this on the test is because they don't give you a calculator that has exponential powers, right? The calculator you get on the test is a simple function calculator, right? So, but if we did that, almost a double. Almost a double. So I say we'll almost double our money in 9 years if we can get 8%. And we start with 10 grand. Now, again, I'm not going to make you come up with the 19,990. I'm going to ask you to recognize the input and the output. Now, another thing we like to ask you to do, here we go, is going the other direction. So we say, how much do I need today to grow to get a future amount in the future? So this amount we're going to need today. So we're starting now with like the 400 grand or the 20 grand and determining what we need to do to put up today to get there, given an assumed interest rate, assumed rate of return. Now, again, I'm not going to make you do the math because we don't give you calculators that have exponential digits on them. But I will ask you to understand the inputs and the outputs. And so here is the answer to the question here, right? So the person says, Dean, if I need 25,000 12 years from today, the obvious kind of example here might be he has a 6-year-old daughter, right? And in 12 years, his daughter will be 18 and she might be considering college. And he says, Dean, I think I'm going to need 25 grand 12 years from today. How much do I need? I said, well, what rate of return are we assuming? Again, that's important because, again, the assumed rate, we can be conservative or aggressive. And then remember, we get more. Sometimes they have questions like, what would happen if you assume an interest rate got better? Then you would say we would get there in 10 years instead of 12. Right. And if we assume 6 and we get 4, then we're going to get there in, 15 years instead of 12. Right. So, I mean, that's going to be an important input. So again, it's mainly the inputs, right? Now, but this is what we need to solve this math. Not can you do the math, but do you recognize the inputs to do the math? If I asked you to do that math, what would be the inputs? What would be the outputs? And so I say, okay, well, if we need 25 grand 12 years from today, and I can get us a 6% return, boom, 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 we need $12,424.23. I'm not going to ask you to do the math. I'm going to ask you to recognize the math. Now, I told you that a lot of times people say, well, I thought I wasn't going to have to do the math. And I said, well, remember, sometimes if it looks symmetric, there's a lot of symmetry in the question, they might be asking you simply to recognize using the rule of 72. And that's fair game. It is fair game to ask you. I might point blank on the test say using the rule of 72. Or I might ask you you have to recognize it. So the minute you get some math, you go, geez. And now I hope that this time around, Houston, we're operating from abundance and not scarcity. Scarcity means we don't have enough right answers, right? So, on this first attempt, we ran out of enough right answers to get us over the top, the hump. This time, we're not going to do that. But I'm hoping you're operating from abundance, and so if you get like something that's hellacious, you go, I think I'll guess B. Assign that to the universe, I'll make it up. But you might want to take a strategic pause and say, okay, well, Dean told me that this quantitative analysis stuff is really sometimes a camouflage rule of 72. So I'm going to look at the question and say, could I use the rule of 72 somehow, some way? And sometimes that's going to be, not obvious. What, in other words, I might say, your customer has $10,000 today, present value. You are assuming a 4% return. How many years will it be to double? And if you don't recognize that you can do this pretty simply using the rule of 72, you might go, oh, man. You say, oh, I know this question. This is the rule of 72. So I'm simply going to take my calculator. I'm going to take 72. I'm going to divide by 4%. And I say, wow, 18 years, Houston, it would take us to double our money at 4%. To be honest with you, that's pretty depressing.
Yeah.
I say, maybe we should, maybe think, should we, maybe we should assume stocks. Stocks over the long term have proven pretty good. And, if we could change that to 8%, woo, that'd be a little more exciting. Now, here's our next version, right? Again, now they may be camouflaged. In other words, now I might say, your customer wants to have 20,000, a future value 20,000. He has 10,000 today. Now, it's up to you to say, oh, that's a double. If you don't recognize that, then you're not going to be able to use the rule of 72. So I say, wow, Houston, that seems pretty aggressive to double our money in 3 years. But geez, I can figure that pretty quickly because I know a little trick called the rule of 72. 72 divided by 3, 24%. Now, I don't know if I'm going to be able to get to 24%, my friend. I mean, that's pretty high return. Now, here is a very similar question that at first glance looks like it's a, present value, future value calculation that Dean told you that you're not going to have to do. But you say, you know what, I can get pretty damn close with this, right? Because I know that, again, it looks like if I took the rule of 72 and I divided, I would get pretty damn close, right?
Right.
There was that one we did the other thing. And I say, okay, well, I can take 72 and divide by 9. And I come up with 8%, or I can take 72, divide by 8, and I come up with 9 years. So again, sometimes it's not transparent that what you're looking at is a rule of 72 question.
Right.
Or different, right? I talked about duration. Remember how I said we're going to ask a duration?
Yeah.
Long and low, right?
Mhm.
Long and low. So duration is volatility. It measures the volatility of the bond prices by weighting the time the bonds takes to pay. Longer duration means higher volatility. So here we go on the test. So here's 2 bonds, and we said we go long and low. So we're going to go for the 2052 because that has a longer term. And then we're going to look at the coupons. They both have the same coupons. So on the test, you would tell me the 4% bonds maturing in 2052 have a higher or longer duration. Right? There's our maturity dates. Boom, that is the bond. Long and low. Let's try another one. So here's 2 bonds. And we go long and low. Now we go, damn. They're both maturing 2042.
Right.
So now I got to go long and low. So I go, boom, 4%. And that's the one that has the highest duration. Again, the most volatility, long and low. And again, that is testable. It's just like your teeter-totter or seesaw, except now they use the word duration. This is the classical example of discounted cash flow. So, you win the lottery. And they say, Houston, what would you like? Would you like a lump sum, or would you like a series of payments for the next 20 years? You say, which is the better deal? Now, I got a guy in a live stream who took exception with what I said, because we were going over this, and I said, listen, if I was confronted with this, and over my career, I have had to do math that is very serious in its nature. And I have a guy I hired to do it. He's made tens of thousands of dollars over the years for me, doing math that I don't want to do, and doing math that I know needs to be done correctly. His name is Lee. Anyways, this guy said, you shouldn't be in our business if you can't do your own math. I'm like, wow. Yeah, no, there's all kinds of very successful people in our business who are not math geeks. There are very successful people in our business who are math geeks, but again, we have to have a general understanding. Nobody's expecting us to have a PhD in modern portfolio theory. We have to have a general understanding of this. Okay, so what is the present value? So what we're trying to figure out here is, what are these payments of 20 years worth today? And when I come up with that present value, I'm going to compare it to what they're offering me. And so let's say I get present value is $50,000 and they're offering me 60. I go, I'll take the 60. Thank you very much. If I get present value is 50 and they offer me 40, I go, nah, I'll take the 50. Right? Now, it's a general understanding. Again, it's not, can you do the math?
Right.
But they do test you on this idea of discounted cash flow, taking a series of future payments and figuring out what they're today. By the way, money today, this concept is called the time value of money. Just so we're clear, money today is always worth more money than the future, right?
Right.
I was talking to my brother. He's convinced, he says, you should take the Social Security as soon as you can get it, because then you get more payments. And I'm like, Chris, I don't know. When I get there, I guess I'll call Lee, say, hey, Lee, tell me what I should do. Should I take the Social Security now, or should I take it, later? All right. So here's these payments, and here's how we're going to test on this. So again, don't get too hung up in the math. But we're paying $9.25 for the bond. You remember how to do that from your Series 7? 92.5. A half is 1% of par, or 1% or half a point of $10. That's $925.
Mhm.
And we're getting 6.5%, or this from your, so that's going to be $65, but that's going to be paid semi-annually, right? So I'm going to get 20 payments of $32.50. Now, again, the idea here is I'm trying to figure out, did I pay a good price for the bond? You know, what I'm trying to figure out is what is present value of the bond. If the present value, by the way, we know the future value is going to be 1,000.
Mhm.
But I'm saying, okay, was that a good deal or not? Now, if again, it's kind of like my lottery thing. If we figure out that the price present value is 920, that I got overcharged, so to speak, right? Because
Right.
I paid 925 and present value is 920. But if I paid 925 and present value is 930, well, then I say, I got a pretty good deal.
Mhm.
You know, I had one of these that I probably posted on the channel. It was a pretty good one. It was kind of obtuse, but I thought it was, legit, but pretty tough. All right. So now what I'm going to do is again figure out what that's worth. We're not, again, we don't have to do the math, but we have to have a general understanding. Okay, what we're trying to figure out is what is the present value of those income streams, those 20 payments of $32.50, and what is the present value of $1,000 10 years from today? And when we get those numbers, then we'll know whether or not this was fairly valued. So if we do the discounted cash flow on the payments, we come up with 371.94. We're not going to have to do the math. We're just saying the present value of the 20 payments of $32.50. If we do discounted cash flow, it's 371.94.
Mhm.
And the future value of that bond at 1,000 10 years from today is 553.68.
Right.
Who cares? That's none of the math. All we need to know is the present value of that bond is 925.62, and we paid 925. In the scheme of things, as a customer, I'm not going to be too worked up about that. I mean, there's other
Right.
things besides present value. I doubt you're taking me to arbitration. 62 cents.
Yeah.
No, but so the internal rate of return is what brings that future value to present value. And if there's no net present value, then it's going to be what we call, zero. I'm going to show that to you in just a minute. So here is what we got. Boom. We paid 921.25. Oh, my bad. I thought we paid 925. We paid 921.25. And it looks like we got a good deal. We got a good deal because when we did the math, we found out that it was 925.62, and we can get it for 921.25. So good deal. I'm not going to make you do anything. I'm just asking you to recognize this idea of net present value. Net always means difference.
Mhm.
And knowing that a positive difference is good, and there, boom, a negative net present value is bad. Right. So you're not going to have to do any math here. You're just going to have to recognize that. Now, discounted cash flow as it applies to a stock. So there's three versions of this discounted cash flow. One version of discounted cash flow is as it relates to bonds, as we did here, right?
Mhm.
But if we apply it to stocks, test question, it's called the dividend discount model. So they'll say on the test, discounted cash flow is applied to a stock as known as, and you got to come with the dividend discount model. Now, listen, we were joking about math geeks. And boy, Warren Buffett is a serious math geek. I was reading where him and Bill Gates became friends.
Mhm.
Talk about geeks, Bill Gates' mom said, "Hey, we know this guy, Warren Buffett, and we think you guys would get along." And Bill Gates said, "Why would I want to know this old man?" This is when Bill Gates was, a much younger man. And they said, "Well, we think he's as smart as you are about math." And Bill Gates said, really? Well, I haven't met anybody smarter than me as it relates to math, or he can even keep up with me. And sure enough, I guess this is how my math geeks bond, talking math, I guess. And,
Right.
they were, became best buds. Anyways, what Mr. Buffett likes to do on his Bank of America stock, for example, is say, okay, well, Bank of America is going to give me 21 cents every quarter as a dividend. So they're going to give me 21 cents every quarter. And let's see, what would be the present value of those dividends? And he does his math and he says, okay, based on the dividend discount model, present value for the Bank of America based on the future income streams, those dividends, is $25. And he says, Bank of America is at 24. I think I'll buy some more. Bank of America is at 26. I think I'll stand pat. He's using that math to kind of gauge whether he wants to buy more or less. Now, you can't apply the dividend discount model. And Mr. Buffett doesn't like to buy stocks that don't pay dividends. Now, the reason he doesn't like to buy stocks that don't pay dividends is because he can't apply the dividend discount model. And that's a test question. To recognize that you cannot apply the dividend discount model to stocks that don't pay dividends. Bank of America used to pay an 18-cent dividend every quarter. Now it pays a 21-cent dividend every quarter. And I'd be willing to bet at the end of the year, they're going to raise it to 24 cents. Seems like that's the pattern over the last, several years. And, and they know Mr. Buffett has 1 billion shares and he would love to see that dividend go up. So now Mr. Buffett can say, do I think the dividend's going to grow? So he builds that into his math and says, okay, I'm getting 21 cents for the next 2 years, but I think in 3 years, it'll be 24 cents, and then it'll be 27 cents, and it'll be 30 cents. That would be called, test question, the dividend growth model. And a couple test questions here. The first test question is, which one of these would justify a higher valuation for Bank of America? If he's applying the dividend discount model or dividend growth model, what would result in a higher valuation, meaning justify paying a higher price for Bank of America, the dividend discount model or the dividend growth model? You would say dividend growth, because the dividend growth would justify or serve as a rationale for a higher valuation. Okay, and then another test question about this is, can you apply the dividend growth model to a preferred stock? Can you apply the dividend growth model to a preferred stock? The answer is no, right? You can't apply this to a preferred stock because a preferred stock has a dividend that doesn't change, right?
Right.
A preferred stock only has a fixed dividend, right? Because the dividend is fixed. All right. Well, that's pretty good session on some of the things that people find, challenging. Right. So when I opened up that test specifications, this was the first part of that document: present value, future value, that kind of thing. When we get together, you can remind me we did that. But again, whenever you do your opening purchase and go along the tutoring session, we can talk about whatever you want to talk about. But you said your date is November 13th?
Yeah, I think we have.
Oh, we have not. Do we have
think
90 minutes?
Yeah, I think
I knew
so.
I had somebody for 90 minutes today, but I wasn't sure who it
Yeah.
was. No worries, no worries. All right, back up we go. So that means my other person's an hour after you. So
Oh.
let me just go grab our thing again. I think you want to continue on with this quantitative analysis stuff.
Yeah, the more you're talking, the more I realized I'm seeing the questions I got wrong.
Oh, well, good.
Like,
That's what, well,
yeah,
it's counterintuitive, but that's actually what we're trying to do, right?
yeah.
Let me just show you where we're at right here, just real quick. Boom. Doo, doo, doo. Yeah, let me see if it'll come back up. There it is. Where'd it go? Wait, oh, there it is. Okay, can you hold on just a sec? Can you see? I know you can't just yet. Can you see now? Okay, now can you see that document that we were talking about?
Yes.
Right, so that where we're at here is that first part, right? The internal rate of return, the present value. We're going to continue on with the 8 questions found in this area. So that's
Okay.
where we're at, kind of going through this thing. Now, just for your own edification, the internal rate of return is what takes the future value to present value, no net present value, 0, basically. The way they ask that is like yield to maturity. Yield to maturity represents that, right? So let's see, boom, boom, boom. Let's get back to business here. And we're doing this. Again, you don't want to overdose on the math. Can you see my screen again?
Yes.
Okay, so we did that one, we did this one. So now we're going to be talking about averages. So we're going to select the proper measure of central tendency when presented with a set of variables. So, Houston, I'm an MBA fan, and it was kind of funny because you have a concept on the test you get tested on called standard deviation. And standard deviation is all about variance.
Right.
And so, I feel sorry for Anthony Davis because people are kind of picking on him based on his standard deviation. What they're giving grief for is, last night in the first half, Anthony Davis, superstar, shows up. He's got 10 points. He's doing great. And then the second half, he didn't have anything. So his average is pretty good, but, he's all over the place. And, they were asking, as a coach, what would you like? Would you, even if you have a guy who has 20 and 10 as an average, there's a difference between the two players. If one night a guy has 40 and 20 and he has 0 the next night, right? Because that means he's got a huge standard deviation. So, I was a Warrior fan, and for years, the Warriors weren't any good. People forget about that for a long time. But, people would say, Dean, do you think you're going to win tonight? And I said, well, it depends what Baron Davis shows up. If Baron Davis superstar shows up, we can take down anybody. But, we don't ever know when he's showing up. Some days he shows up and, he's just an average kind of guy. But all right, so the sum of the variables divided by the number of occurrences is known as the average. I would be prepared to do a simple average on the test. And the simple average you have to do on the test is typically about dollar cost averaging, where they tell you that a client has a fixed number of dollars to invest regularly, like $100 every quarter. And then they say, when he gives you the first $100, it's 5, and then it's 7, and it's 5. And then you have to figure out the average cost and the average price and compare those two. And the idea on that is that when you dollar cost average, your average cost will be less than those underlying shares. So I would be prepared to do an average, particularly as it relates to dollar cost averaging. So over the past 7 years, a security has produced annual returns of 10%, 4%, 5%, 10%, 12%, 2%, 6%. Now, every once in a while, when I'm presenting this math, somebody will say, well, does the negative numbers count? I go, absolutely. If this is your stock or your portfolio, when it goes down, that counts. That counts. So now what we're simply going to do is we're going to add up all these numbers, right? We add those all up, and then we divide by the number of, things that are there. So we get 35. And there's 1, 2, 3, 5, 1, 2, 3, 4, 5, 6, 7. There's 7. Don't you love this? We're going to talk like math geeks now. There's 7 in the data set. Now, if you're a serious math geek, sometimes you say, well, what's the data set? Right? And I say, well, the data set here is 7. So I would be prepared to tell me that that's 5%. Right. So the way we do that is we total it all up and then we divide. So if we take 10 plus 4 minus 5, I do it as I go, but you have a calculator, but 10 plus 4 is 14, minus 5 is 9, plus 10 is 19, plus 12 is, 19 plus 12 is what, 31, 29 minus 6, and that's how you get that. You get 35. All right, so the next thing we get asked is the median. I don't, mom is retired. I take care of mom. I'm lowering my voice right now because I don't want her to hear me, but I'm not going to take her car away. I will at some point. I'll have to drive Miss Daisy, but she, told me that she was accidentally driving on the median and didn't know it. Oh man, the median is the middle part of the road. That's not, mom shouldn't be on the middle part of the road, right? She should be in her lane. I'm not even going to tell my brother because I was joking with mom. I said, if you tell Chris that, he's going to try and take your keys away from you. So now she still does okay, at some point. I always think of her when I think of medians. I always joke, we get in the car, she's driving, I say, stay off the median. So, make sure you're staying in the lane. All right, so the median is going to be the midpoint of the distribution, the middle. I think that's what I think of as the middle. So here we say, okay, well, if we sort these numbers out from -5 to 12, we have 7 numbers in the set. And so it looks like the median number in the set is 6. That's the median. By the way, it's helpful to sort out the numbers too, because the difference between those, I always think of my friends in Minnesota. They'll say, oh man, it warmed up today. I go, are you guys nuts? It went from -5 to 10 above, 5 below 0 to 10. They go, well, yeah, Dean, that means he heated up 15 degrees. I go, man, you guys are nuts. So the range, we'll do mode first. Mode is the number that occurs most often. So here in our set, the number that is occurring most often is 10%. And then the range is the difference between the lowest number and the highest number. So here, the difference between the highest and low returns is the mid-ranges in between. So over the past 7 years, same secure, calculate the range. So I always think, I don't tell, I think of it as a thermometer in my friends in Minnesota.
Right.
If it goes from -5 to 12, that's 17 degrees. That is the movement in the security from -5 to 12. So the range is here, we sort it out, and that is the range. Now, in between there, here's our example. Boom. Right? That's the total movement on this number line in terms of returns. It goes all the way from -5 to 12%. And then the midpoint would be in between the two numbers, right? 3.5 is halfway in that total movement. 3.5, because remember, we started at -5.
Right.
So that is the midpoint. Alpha and beta. We talked about beta. We said beta measures a volatility. We call this, volatility, the variance between the market and that is called beta. And a risk associated with beta, if we have an average amount of risk, it's 1. That's what the market does. And if we're willing to take greater risk and we expect to get a greater return for doing so, a beta greater than 1 means it goes up or down faster. Beta goes both directions, by the way. Beta is both directions, up and down. And if it has beta of less than that, you're going to have below amount average of risk. Now, I would tell you, Houston, that means when the market goes up, you're going to underperform. But when the market goes down, you're going to outperform because you're still going to be a loser, but you won't lose as much.
Right.
Because you have a lower beta. So, yeah, and again, this is important to know what kind of level of volatility is my customer comfortable with. What kind of risk tolerance are they comfortable with? And then again, I might have a conversation where I say, Houston, I don't want to, usually the portfolio I would design for a client like yourself would have a lower beta, but, I think we have to have a higher beta because we're starting later, and our time horizon is such that we got to have to take a little more risk, but, or I say, hey, listen, there's no reason, Houston, for us to take more risk. I mean, we got plenty of time to get to our financial destination. So why take extra risk if it isn't necessary. All right, so alpha we said is that expected return, above whatever beta is the expected return. So, if we get a higher return, I gave you an oversimplified version of this as we started this session. I gave you a market return of 10 with a beta 1.5, and we came up with an expected return of 15%. And then I told you we got 15 and we were happy because we got more than we expected. And so woohoo. And then I gave you an example where we got lower than expected. And remember, we weren't happy. And then if we just get that 0 alpha, well, that means we, all we got was the beta. And, maybe that's fine. Maybe that's all we want is the beta. Okay, so I'm not going to make you do this on the test. But again, I'm adding another variable now to this idea that I shared with you earlier. And the new thing I'm adding to that discussion is we should not forget that we can make a return without risking our capital. So, Houston, one thing we should take into account is that we can get 3% risk-free. And we can get that without hazing our capital, without buying a stock. And as I told you, this is typical of the exam itself. Rather than just telling you what the market did, that we said stock A has a beta 1. Now, as a test taker, the reason that's important is because now as a test taker, I say, okay, well, so whatever stock A did, that is the market return. Because they told me it has a beta 1. The stock B has a beta 1.4, so it's 1.4 times more volatile than the market. And now they tell me the stock A had a return of 13%. Now, remember, that was important because now I know the market did 13%. Stock B has a return of 19%. What is the alpha? Okay, so here, as you can see, in terms of the formula, we're going to take the market return, which was 13%. We're going to minus the risk-free rate of return, because remember, that's what we could have got without hazing our capital. So of that 13%, we could have got 3 of that without doing anything. So that's really 10. And then we're going to multiply by the beta. So, and see what we did. So here's our expected return. And the reason we're minusing out the 3% is because, remember, that's what we could have got without doing anything. So what we really got from the market is not 13. We got 10 because we could have got 3 without messing around. So in terms of math, we always do parentheses first, right? So we're going to take the 13 minus the 3, and we get 10. And boom, so now expected return was 14%. And we got 19. Now we got to be careful here again. And the reason we got to be careful is we say, okay, 19, we're happy. But remember, of the 19, we could have got 3 without doing anything. Right. So we're going to back out the 3. And it says we got 16, so we are happy. We are happy because based on beta, we did better than that, right? We were expecting 14 and we got 16. So we are happy campers. We are happy campers. Now, again, I don't think we're going to make you do this kind of math, but we are going to ask you to recognize this idea of excess return being called alpha. They definitely could just point blank say returns in excess of beta can best be described as, and you got to come with alpha, right? And then again, this idea of positive alpha is good and negative alpha would be bad. So here we're excited because we actually got alpha. I mean, there are entire investment advisory firms called Seeking Alpha. And boy, if you're going to hold yourself out as seeking alpha, boy, you better find it, because otherwise your customers are going to be,
Yeah.
Now, I kind of gave you this idea, and again, this is mainly a recognition question. Okay. Right? So I just told you that Anthony Davis has a very high standard deviation. I mean, by the way, it's got to be tough to be an athlete, and everybody's like talking about you, and you're like, I don't know, maybe he doesn't watch TV, but Yeah, there were some people that stood up for Anthony Davis. Well, remember when the Lakers got a ring? Look how he was playing then, man. He was, he was taking and I said, yeah, well, yeah, that's kind of the point is,
What happened?
so
Yeah,
that's what people say, well, we know you can do it. We've seen you do it.
yeah.
So it's a statistical return that measures the amount of variability, variance, that's testable, or diversion around an average and the volatility of the projected returns using historical performance data. And so here we're asking what company is more volatile. So company A had a 5% return in 2019, had a 15% return in 2020, had a 10% return in 2021. And so I add that up, 35 divided by 3. -2, company B had -2%, 10%, 22%. I add that up. And when I do the mean, it looks like they both have the same average. But which one has the higher standard deviation? It's company B, right? Company B is that basketball player I kind of told you about. Like, he's all over the place, and then, a lot of trades went by and, the Celtics got a guy named Drew Holiday, and everybody loves Drew Holiday because he's a consistent guy. Every day he goes out, you know what you're gonna get, and then again, in investment, the same way, right? Well, if you want to take a flyer, then take a flyer, but you just should be conscious of that. It's company B, right? So even though they have the same average, I always think it'd be fun to ask the coach, right? What would you rather have? Would you rather have a reliable 20 and 10 guy, or would you rather have a guy on the bench that who knows,
Yeah.
throw him out there and see what happens. So this is just that pattern. And as you can see, company B has a bell-shaped curve that has, a bigger spread there.
Right.
In terms of, again, I'm not going to make you do it. I'm just going to ask you to recognize this idea of variance and how it relates to volatility. Correlation, very testable. So we've been talking about modern portfolio theory. And we said it's not truth, it's just a way of explaining things. So, let's say that I have Exxon already in your portfolio, right? And let me just clean up my slide here. So I'm trying to decide in terms of diversification what I should put into your portfolio. So here is stock A, and let's call stock A Exxon. And let's say I put Chevron into the portfolio. Under modern portfolio theory, I haven't really accomplished anything because Exxon and Chevron have almost perfect positive correlation. I mean, they're pretty much the same business if you think about oil and gas, right?
Right.
Last night I'm getting ready to go to my cabin, and Mom was afraid about how cold she's going to be, and I said, Mom, if you want, we'll run down to Lowe's and I'll buy you some more propane heaters if you want. I said, there's already 4 there, and there's a mini split heater, but and she goes, well, I want 3 more. I said, why would you want 3? Well, because I can have 2 going. I got fine. So I went into Lowe's and I bought her 4 of these propane heaters. But to be honest with you, I couldn't tell Houston whether it's a Lowe's or Home Depot. To me, they look very similar. So, I mean, if I already have Home Depot in your portfolio, why would I put Lowe's in there? Or vice versa, because there's, positive correlation. Now, let's say I have Exxon in the portfolio, and I say, okay, I want something that has a different correlation. Maybe I put Delta in there, the airline company. Because now when we think about the price of oil and how it will impact these companies, if the price of oil goes up, that's going to be good for Exxon, but bad for Delta because Delta needs, jet fuel to fly around. And if the price of oil goes down, that's going to be bad for Exxon, but that would be good for Delta. And so I say what I've done here, Houston, is I provided our portfolio with negative correlation, which reduces the volatility of your portfolio. So when Exxon goes up, our Delta goes down, but when Exxon goes down, our Delta goes up. And then that is the idea on the test, is to recognize Negative correlation is a positive part of modern portfolio theory. They might even just express it as a number on your test. In other words, they might just tell you this has correlation of 1 and this has correlation of -1, and say what would provide the most additional diversification, and you'd say boom. Now be careful. Sometimes RTFQ, read the full question. Sometimes they say what would provide the least amount of diversification, right? So if I say least, then I'm asking you to come up with this answer.
Right.
And if I say most, I'm asking you to come up with that answer. So you just got to be careful that you're not on the backside of whatever question you're being asked. All right, so there we go. Inverse. On the test, it's not called inverse. It's called negative correlation. No correlation and perfect correlation. You'll never get perfect correlation, but you could come close, right? In other words, Chevron and Exxon are different businesses, but right, I mean, they're very similar.
Right.
Okay, so balance sheet stuff. This is that same 8 questions, and on the balance sheet, it's going to be a little more involved than 7 is in terms of this. This is testable on 2 levels. And what I mean by that, it's testable on the corporate level, but it's also testable as it relates to a customer. I say, Houston, for me to do a really good job for you over time, I need to know a lot about you. The more I know about you, the better I can determine suitability. And so what I like to do for new clients like you is sit down and do a personal balance sheet. Could you tell me, Houston, about your current assets, your cash, or things you plan to turn to cash within the next 12 months? Could you tell me about your long-term assets, your house, your retirement plans? Could you tell me about your current liabilities, things you need to pay within the next 12 months? Could you tell me about your long-term liabilities, your mortgage on the house? And what I'd like to establish is your net worth. And then what I'd like to do is revisit this, and hopefully, we can get that going up. All right, let's go through this balance sheet, and then we'll do some questions here. So the company ABC, it's a picture in time as of October 26, 2023, today's, right? So if I said to Houston, let's look at this today. So they have $5 million in cash. They have $15 million in accounts receivable and $20 million in inventory. Now, we don't want to have to sell our inventory if, because we can't pay our bills.
Right.
Because, if we have to do an inventory reduction sale, that's not going to be good. So quick assets, test point, are current assets minus inventory. And I would know that. So in this example, if I ask you, what is the quick assets? We'd say, okay, well, the current assets are 40 million. And of that 40 million, we're going to deduct the inventory. And so we would say that this company has 20 million in current quick assets. Okay, so again, we said we might want to do this as it relates to a person. Let's go over the other side here. So they owe $5 million in accounts payable. Oh, I'm sorry, we got to go down with the fixed assets. So we have 40 million buildings and furniture, 15 million in land. So total fixed assets of 55 million. And we have intangibles, goodwill. This could be our brand. This could be a patent, something like that, right?
Mm-hmm.
And that would be total assets of 100 million. We have accounts payable of 5 million. We owe our employees 4 million. We owe the IRS $1 million. So we have total current liabilities of 10. We've issued some long-term bonds that are convertible. We've issued $50 million in 8% bonds that have 20 years to maturity and are convertible at 50. We have a net worth represented by our preferred stockholders, who, remember, are senior in liquidation. And we've issued 20 million divided by 100. That's how many shares we've issued. We have 1 million shares in common stock outstanding. We said that's 1 million. It looks like we sold it for $5.
Mm-hmm.
because we have excess over par. And then over the years, we did not distribute to our shareholders some of our earnings. Some of the earnings we kept for ourselves. That's typical. We pay some of the earnings as a dividend. The board decides about what this number is. And then we keep some to build the business. Here recently, Intel said, until further notice, no more dividends. They said, we need our dividends. We're going to retain any earnings we have because we're, to be honest with you, we've made some mistakes, and we got to get NVIDIA's kicking our butt, and we got to build some new chip factories and come up with new chips. It's going to cost billions. And so we're not going to be distributing excess capital because we don't have any. Right. And again, a lot of people go, what do you mean no dividend? Again, it's very important as an investment advisor rep to know that you don't have a right to a dividend. You only have a right to a dividend if declared. Now, we said the book value test question represents the theoretical liquidation value of the business. Theoretically, because we don't assume we're going to liquidate the business. But if we did, we start with our net worth of 40 million. And if we're liquidating the business, we got to pay back our preferred stockholders, very testable. Preferred stockholders are senior in liquidation. Now, to be conservative, we're going to assume that our intangibles aren't worth anything. I was pretty surprised, yeah. Bed Bath & Beyond filed Chapter 7 liquidation. And a company called Overstock was able to buy their brand for $5 million. I thought, man, I would think it would be worth more than $5 million, that brand. And wow. Overstock now has rebranded everything to Bed Bath & Beyond. And if I were the Chapter 7 trustee in bankruptcy, I'd say, gee, sounds like that brand has some value. Maybe not. Maybe I haven't been to Bed Bath & Beyond store in a while. Maybe people are like, oh, that sucks. But I was surprised how quick they turned it over. I mean, it was Overstock one day, and now it's Bed Bath & Beyond.
Yeah.
Anyways, we're not going to count the intangibles because who knows what we're going to get for those. And so we have 15 million. And remember, we have 1 million shares outstanding. And I'm not going to make you do the $15, but we do have what are called fundamentalists. And a fundamentalist is not a member of the religious right. A fundamentalist is somebody who likes to look at the balance sheet, the income statement, the industry, the economy, and look for a margin of safety. Right. And the margin of safety here would be the book value as compared to the market value. And I said, well, if I can buy this stock at something close to its asset value, that would give me a margin of safety in terms of that. The only test question here is to know that that represents the theoretical liquidation value of the business. Now, you do get tested on some liquidity ratios, either recognizing them or actually having to do them. It depends on your draw. So it could be A, B, C, D, or it could just be, figured out based on this exhibit. So working capital test question is current assets minus current liabilities. And I told you that alone could be a test question. What best describes working capital? And you would say current assets minus current liabilities. They might even ask you, based on this exhibit, to tell me on the test, what is the working capital? So our current assets are 40 million. Our current liabilities are 10. So our working capital is 30 million. They do more of this on 66, by the way, than they do on 7.
Yeah, I think I only got like 2 questions max.
Yeah.
On the 7 related.
Yeah, I had somebody, ask about the balance sheet, and I said, well, if you're going on the 66, you might as well pay the price. You're not going to get tormented on the 7, but you could be, tormented on the 66.
Yeah.
All right. So now, again, liquidity. Some people need more liquidity. Some people need less liquidity, depending on not only the corporation, but also as an individual. Some financial planners say you should have 3-6 months as a rainy day fund. Right. Another thing we're held accountable for is the current ratio. Ratio always means division. So if you can't decide what to do, what should you do? Divide.
Divide.
And if you can't remember what to divide, you take the first number and you divide it by the second number. So the current assets again, by the way, I could either ask you to recognize it or to do it. Right? What best describes current ratio? And you would say current assets divided by current liabilities. And then I might even ask you to do it, in which case we take 40 million, we divide by 10 million, and we say 4-1. So either recognize it or actually do it. Now, as I said earlier, we don't want to have to sell our inventory to pay our bills. So what we're looking at right now is the liquidity of ABC. The liquidity of ABC as of October 26, 2023. And we figured out they had 30 million working capital. They have $4 in current assets for every dollar they owe. And the most stringent version of this is what's called the quick ratio or the acid test ratio. And I may ask you to just recognize it, best describes it, or do it. So the quick ratio is we're going to take the quick assets. Remember, the quick assets are the current assets minus the inventory, right? So we had current assets of 40 million. We had inventory of 20, and so we had quick assets to 20 million. So now we do it again, and we say without counting our inventory, we have $2 in quick assets for every dollar we owe. Again, from a fundamentalist view, from a value view, this sounds like a pretty good company so far. I mean, we don't know what the price is, but looks like they got plenty of money, and everything is going pretty good. Now, there's no such thing as a corporation that doesn't have shareholder or hasn't issued common stock. And here what we're asking is how much of the capital, the capitalization of this business is 40 million that belongs to the shareholders, and 50 million we have borrowed from bondholders. So our total capitalization is $90 million. And now what we're thinking is, okay, well, how much flexibility or lack of flexibility do we have because of the borrowed funds? The more money we own to bondholders, the less flexibility we have in the business. And so now what we're trying to figure out is how leveraged is this company in terms of its capital? Listen, I would say selling toys against Walmart and Amazon is tough. I mean, Toys R Us went bankrupt, but it didn't help that they owed billions of dollars, which means they have to sell way many more toys.
Right.
And so, I mean, if they didn't own anybody, and I was talking to my brother, and I said, well, Chris, I thought the whole point of going off grid is not to have bills. So why are you going to borrow that money? And, if I were you, I would just suck it up or, go to the bank of Brother Dean because, and anyways, I said, Chris, if you can't go bankrupt, if you don't owe anybody any money, so you're off the grid and you don't have any bills and you don't owe anybody any money, then you can't go bankrupt. And he goes, wow, I never thought of that. I go, well, I wish I would have told that to you 20 years ago. Right?
Yeah.
So here we go here. So we're going to have 50 million plus 40, right? So our total cap is 90. Now, again, what we're concerned with here is how much of that 90 million belongs to our creditors. And so now what we're going to figure out is what's called the debt ratio. And this is the last one that I think you need to either recognize or be able to do, because remember, it's going to be A, B, C, D. We don't know which one it's going to be, A, B, C, or D, that they're going to ask you to do. They're going to ask you to do all four of them.
Right.
They'll ask one of them, and we just don't know which one it is. So now we take the 50, we divide by 90, and I say, okay, a little over 55 cents of every dollar in capital in the ABC Corp does not belong to the owners.
Right.
It belongs to the bondholders. And so we have a certain amount of leverage here. Now, that leverage could be a good thing or a bad thing, depending on what happens, right?
Mm-hmm.
Leverage means we're going to make money faster, but it also means we're going to lose money faster. Earnings per share. So earnings available to common. Now this would be given information, but the earnings does not show up on the balance sheet. The earnings per share shows up on the income statement. So the financial statements include a balance sheet and income statement. And so here we see that the top line, you probably heard of that before, the top line. That's the revenue. So this company had top line revenue as of September 30th, 2000, whatever, of 87 million. They had cost of goods sold of 20 million. operating costs of 10 million. They had an operating profit of 57 million. Who cares? We don't really care about the top line. We care about the bottom line. You probably heard that people, what's the bottom line?
Hmm.
We're hoping by the time we get to the bottom line, there's still some money left over, right? So,
Yeah.
so here we have an operating profit of 57. We had earnings of 57 million. We've got to pay our bondholders 5 million. So we have taxable income of 52 million. We got to pay the IRS. So now we have net income after taxes, very testable. Preferred stockholders have preferential treatment in liquidation and dividends. So we got to pay our preferred stockholders. It looks like we owe them $800,000 in dividends. So I say, hey, fellow board members, we have $34,200,000 left over. Those are monies that are available to our common stockholders. And how much of that do we want to distribute as a dividend? How much do we want to distribute as a dividend? And I said, well, let's declare $1 million worth of dividends. Cool. Now, remember, what we don't give to the shareholders shows up as retained earnings. So we're keeping this $33,200,000 to build the business. You know, some companies are very stingy with dividends, and other U.S. companies are a little more generous with dividends. You know, usually the more mature and stable the business is, the higher the dividend payout ratio will be. But, you know, dividends are associated with mature, stable business. And now, based on this, earnings available to common, we can figure out the price to earnings, right? Because we know that we have that available and we have 1 million shares outstanding. So to get our earnings per share, we're just going to take the 34,200,000, we're going to divide by the million, and we find out the earnings per share is 34.20. Now, again, you won't have to do that, but you certainly are going to have to know price to earnings. So we have the earnings, price divided by earnings. You can't decide what to do. We divide. And again, this is important because we either are a practitioner of value investing where we want lower PEs, or we're a practitioner of growth where we say we'll pay a higher PE because the earnings we think are going to grow.
Right.
You know, price earnings means how many years does it take me in earnings to get back what I paid in price. So the market price here is 410. That's given information on the test. They'll say the current market price is $410.40. And the earnings are given on the test. You don't have to do the 34.20. It's given. But what you have to do is then divide that and come up with a price to earnings ratio of 12-1. And then have a general understanding that some people will be willing to pay a higher PE and some would be willing to pay a lower PE. You won't have to do price to book, but remember, as a fundamentalist, I'm trying to get some margin of safety. And, you know, the higher I can get, or the closer I can get to book, the more margin of safety I have. I'm not going to make you do anything with that. It's just part of fundamental analysis. Well, we ran a little over, but at least we nailed that whole section of the test, which is kind of cool.
Yeah.
So we got all that done. Remember, that whole discussion was 8 questions.
Wow.
All that whole unit, it's 8. Now, the problem is we don't know which 8.
Right.
Right. So, I mean, you know, that's the challenge, right? So